Alrighty, guys, today we're going to go over Chapter 5, which is now the completion of the accounting cycle that we've been going on since beginning of Chapter 3, Chapter 4, and now Chapter 5. So what we're going to start on is then we're going to be journalizing the transactions again. The trial balance has been prepared, worksheets completed, financial statement prepared, but now what we're going to do is we're going to journalize post entries, meaning we're going to close the balances and prepare a closing trial balance as well. Don't worry about the terminology yet. I'll be explaining it as we go on. Okay. So first thing that we do, of course, remember we've got the journal entries. We record from the worksheet. It's up to date, either on a daily basis or a weekly basis, whatever the case may be. Our financial reports provide us where the business does stand. Did we make money? Did we not make money? And then, of course, remember, we're putting in adjustments to record things that maybe were left out of the journal. We forgot to put them in, so we now have to put them in. Maybe we didn't see an invoice that we have to add, or a payment that we forgot to add as well. So we have to make sure that we're going to go ahead and be ready for the next accounting cycle. So when we're doing the adjusting journal entries, again, we prepare, and that brings the ledger up to date. It brings the adjustments of the depreciation, should we have any equipment that needs to be depreciated, trucks or anything that needs to be depreciated, brings all of that up to date as well. So remember, as we did before, the adjustments go in. These are the items that have been left out, whatever has been talked about. For example, where you're actually bringing in computer supplies, okay? Making sure that you've got your adjustments, taking inventory, how much we have on hand, or a computer supply expense that we're actually going ahead and possibly adding more, who knows. So again, showing the rent expense that was not done here before finishing up our trial balance. Adding these entries of a depreciation and accumulative depreciation because it was forgotten. A salaries payable that was forgotten to be added. And then once we do that, of course, we then make sure that we're getting them, and again, we're getting them from the worksheet. Some way, somehow, we forgot about putting them in, so we're taking them again. And then we have to go ahead and add them. We also have to add them to the journal entry as well, or the post worksheet as well. So this is what we're going to do. Next period's transactions are made easier by closing the procedure. Again, it's like reconciling a checkbook. I've reconciled my checkbook for the bank. I know exactly how much money I have in my bank account. Now I can begin to spend money, yes or no. Or I need to make a deposit, yes or no. Closing also allows you to make sure that the revenue and the expenses for each month are kept within that month. So that's why it's called a closing. That balance doesn't go forward. That balance stays there only for the month. Okay? So we have what is called a temporary or nominal accounts, and then permanent or real accounts. We're going to get into those definitions as well. We do again notice the accounting equation: assets equal liabilities, capital minus withdrawals. Okay? And the reason that it's minus withdrawals is because you're taking it away from the capital, the money that you have in cash, or that's your main asset that you can withdraw from. Then you add your revenues, and then of course making sure that you subtract your expenses. Okay? Assets, liability, and capital, those are your permanent accounts. Remember, the capital account does not change at all. They're carried over from one accounting period to another. Whatever your assets are carried over. Whatever your liabilities are, you carry over, okay, because you still owe them and you still have them as far as your assets. Withdrawals, revenues, and expenses, those are called nominal or temporary accounts. The reason they're called temporary accounts is because of the fact that those balances do not carry over into the next month, because those are the expenses for, let's say, January. If those are expenses for January that have already been paid, then they're going to go ahead and not be carried over as far as balances are at all. They're going to be just for that month. Revenue is the same thing, that money that you made during that accounting period, and that's it. A liability, which is a permanent account, is a payable. You still owe it. It will be a payable until it becomes zero, that you don't owe it anymore. Okay? But it's still considered a permanent account until you zero it out, saying that you don't owe it anymore because you paid it out. Like paying the last payment on a car. You don't owe it anymore. Therefore, it's not a payable. It's not a permanent account anymore because you're done paying for it. Okay? This allows for the accumulation of new data in the accounting period, which allows you to see how much did I spend for January, how much did I spend for February. And then when we total all of those totals at the end of the year, then you can see how much you spent overall. But you can still analyze, which is what accounting is, analyze going back to say, oh yeah, but I spent more of it during this month. Why did I spend that much during this month? And you can determine that. You can determine whether or not you're going to continue to do it or not. So in order to close a entry, you're going to clear to zero the revenue balance and transfer it into the income summary. We're going to clear to zero the individual balances, transfer them into the income summary. Then we're going to zero the income summary, transfer it to capital, and then we're going to clear to zero the balance and withdrawals and transfer it to capital. And I know what you're doing. You're saying, what? Here we go. Okay. So for step one, okay, close the revenue accounts, meaning that's all the money that came in. Then you close all of the expense accounts, zero balances, okay? Then you bring these balances into the income summary, either net income or net loss. Then you transfer that to capital. And of course, with step four, though, sorry, you also make sure that you close any withdrawals to the account that were made during that month. So this is what we're talking about, okay? Here we go. Step 1, computer repair fees, okay? Step 2, here we had the office salaries expense. Step 3, we had a net income. Step 4, this is the amounts as far as the withdrawals, okay? So we're looking at those, closing them out. Notice they're in the balance sheet, they're in the income statement. To clear the revenue balance, this is what we're going to do. Your revenue, of course, okay, is a credit balance. So you're going to then debit it to zero it out completely. The reason why, again, is because you're bringing money in. And the reason that it's on the credit side is, remember, because you debit what? Debit your cash, credit your repair fees, right? So what you're doing now is, though, you're actually debiting your computer repair fees and you're now crediting your income summary as far as revenue, showing that you have zeroed it out. And I know what you're saying. Why can't I just put in the 8,000? I'm done. Because you are the rules of accounting. You debit and you credit. There's always two accounts that we're dealing with. So you must debit computer repair fees to zero it out, but then you must take that into your income summary to credit it, okay? Then you're going to go ahead and zero out the individual expense balances as well. Office salaries expense, your telephone expense, your rent expense, your advertising expense, your computer expense, supplies expense, and your computer depreciation expense. So what are you doing? You're now debiting your income summary, and now you're going ahead and credit all of these expenses, And why? Because remember, your normal balance for the salaries expense is debit on the left side. So you're debiting it. All of this totals up to 3,100. So all of this adds up to that. And now you're just individualing out. And then, again, you're closing the individual accounts. Closing, 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 closing. Okay? You're closing this, closing this, closing this. And all of this totals this amount. Okay? Now notice, you have revenue in the income summary, and you have expenses in the income summary as well. So then what you do is you clear the balance in the income summary. So again, you have your credit and you have your debit. So you subtract your revenue of and your expenses. So you subtract your $3,100 from $8,000, bringing you down to $49,000. Okay. So that's what's in your income summary, that you've made money. So then what you do is you take this $4,900, right? You've got it debited here, and then you credit the capital. Why? Again, because the capital, that's the normal balance. Debit and then credit. So here's where you're doing this again, showing it a little bit more in detail. The $31,000 of expenses, revenue, debit to close, and you've got your net income. Then you add it to your capital account. Okay. So then what you do also is you have this amount here. Now you're going to close your withdrawals. So what you're going to do then is you debit it, debit the capital, debit the withdrawals, debit the capital, and then credit the withdrawals so that it closes it out. And then you see all of the closing to the income summary right here. Okay, step 1, step 2, step 3, and step 4 in your general journal. Notice at the end of the accounting cycle or on May 31st. This is where we did the summary the revenue coming in. This is where you went ahead and you had your income summary debited for all the expenses. Then you also had your net income, bringing it out. Then you're taking your withdrawals as well, step 4, and taking it out as well. Okay. Then we do what is called a post-closing trial balance. This is the last step of the accounting cycle. It lists only the permanent accounts. Remember what I told you the permanent accounts were at the beginning. And it aids in checking whether the ledger is in balance, the general ledger. Same procedure as for the trial balance. So here we go. So post-closing trial balance. We have our cash account. It is a permanent account. Accounts receivable, again, computer supplies, prepaid rent, computer equipment, all the assets. Accumulated depreciation, which is a liability, considered. Well, it's actually not a liability. It is a I'll bring it up in a second. It's a contra account because of the depreciation of the value of your computer equipment. Then you have your payable. You're still paying on it. Your salary is payable, and your capital account that never goes away. So when you add all of these accounts and you add all of this as well, come out, and again, you're balancing out. So this is what we're doing. Collect all the sources from the business transactions, analyze them, post or transfer them to the journal, to the ledger, prepare the trial balance, prepare the worksheet, prepare your financial statements. Then you post your adjusting entries. Then you post your closing entries. And then you prepare your post trial balance. Everything still has to balance out. And this proves the mathematical accuracy of the closing process as well. Okay, so this is what we've done. This is what we're going to be doing for your summary. And I'm going to do the daily assignment as far as a demonstration so we can get going with this. All right, so I'll see you on the flip side.